The economy is now deteriorating at an even faster pace than what we first thought, with US payrolls just getting revised down by a staggering 911,000 jobs for the last 12 months, the largest cut ever throughout history. Now, it's hard to stress enough just how bad of a sign this is, as it means that the economy has delivered less than half of the jobs that were previously reported, figures that are more ugly than the 2009 financial crisis levels. And it's consumer-orientated categories that are dragging down the data the most, with the leisure and hospitality, trade, transportation and utilities categories seeing the biggest downwards revisions. Now, taking these downwards revisions into account, this now actually puts many employment sectors into negative territory, meaning that they have actually lost jobs in the last 3 months. We can also see that the jobs market is massively being propped up by one sector, the private education and health services sector, which is preventing the labour market from looking even weaker. On top of this, the unemployment rate has just ticked upwards again to now being at 4.3%, the highest level since 2021, and consumers are feeling this stress in real time, with consumer expectations of finding a job plunging to lows exceeding the bottom of the pandemic era. And while the jobs market and overall economy continues to weaken, CPI continues to tick up higher, rising now for the 4th consecutive month, up to 2.9% in August. Now, this is a jump up from the 2.7% figure in July, the month prior, and is now 60 basis points higher than the 2.3% that we saw in April. And this is assuming that the CPI inflation data is even correct, as the percentage of the data that is now being estimated has surged to a staggering 36%. Now, this is an alarming surge in the amount of CPI data that is being completely made up based on assumptions and not real prices at all, and is far higher than the approximately 10% figure that we do usually see. Now, with so much data in the jobs market being revised down so drastically, it really does make you wonder how accurate these CPI numbers even are, and whether inflation could actually be much higher than what we're being told. Now, Mark Zandi, the chief economist at Moody's, said, "Inflation is uncomfortably high and it's accelerating," and he believes that we should expect to see a further acceleration in inflation over the next 6 to 12 months. And now the CEO of JP Morgan, Jamie Dimon, has also just warned us that this new economic data confirms that the US economy is slowing down, emphasising the fact that the economy is definitely weakening and that the Federal Reserve will probably reduce interest rates as a consequence of this later this month. Another major bank, UBS, has even now put the odds of a US recession up to a 93% chance. So with a stagflationary recession on the horizon, a situation where the economy is declining while inflation is rising, many large financial firms and global banks are making moves to diversify themselves away from the US dollar now too. Goldman Sachs analysts are warning that the US dollar's global reserve currency status is under threat and could be eaten away by gold and Bitcoin. They say a scenario where Fed independence is damaged would likely lead to higher inflation, lower stock and bond prices, and erosion of the dollar's reserve currency status. Goldman analysts, including Sam Dart, see gold as a store of value that doesn't rely on institutional trust, and as a result of the current economic and political landscape, it does remain Goldman Sachs's highest conviction long play in the commodity space. Now, they estimate that the price of gold will rise to $5,000 if Trump's war on the Fed continues to cause global investors to lose confidence in bonds, stocks and the dollar, and causes just 1% of the privately owned US Treasury market to flow into gold. We can see already that the US dollar's share of international reserves is getting smaller and smaller, and this decline seems to only be accelerating in recent years, with gold being the main asset replacing it. And we have recently seen that central banks now hold more gold than US Treasuries as a percentage of reserves, something that has not been the case since 1996. Now, this is largely due to the declining trust that global central banks have in the US economic situation, as well as fiscal and monetary policies, and also the growing movement by BRICS nations away from US dollar reliance. Now, JP Morgan also agrees with this, warning that a US dollar crisis is ahead, with their latest research showing that despite the currency being down 9% year to date so far, signals are pointing towards it weakening even further, an extremely concerning alarm of what could be ahead. And their research shows that the currency is still trading about 7.3% above its long-term average, even after these recent drops, suggesting that there could be more weakness ahead. We are also seeing an increased number of insider sales take place in the stock market, with the CEOs and executives of the world's largest public companies cashing out at these current high stock prices while they still can. It has been a sea of red during the final week of August, as out of the top 200 insider trades, every single one was a sell order, with not a single one being a buy. And then for the first week of September, we are seeing a similar pattern, with 198 of the top 200 insider trades being sales, meaning that over this 2-week period, we have seen just 2 of the largest 400 insider trades be buys, with 398 being sales. And one very prominent insider who has been ramping up their sales recently is the CEO of the most valuable company in the world, Jensen Huang, who has recently just filed a number of notable sales of Nvidia stock and continues his selling spree that he has been doing since June earlier this year. It's very clear that right now stocks are extremely expensive and overvalued, with the S&P 500 forward PE ratio currently sitting above 22, which aside from the peak pandemic bubble period in 2021, is the most overvalued the market has ever been at since the dot-com bubble. Now, the stock market and the economy seem to be very disconnected right now, with stocks surging every week, hitting new all-time highs, while many economic indicators, including the recent poor jobs market data, are all pointing towards major weakness in consumer spending and the overall economy. We have just seen a bunch of alarming consumer data come out recently, with credit card debt continuing to rise and delinquencies on this debt surging to levels not seen since the financial crisis, a sign that desperate consumers are turning to credit cards to afford to live, but cannot keep up with their monthly payments. Now, consumer sentiment is also plunging, especially around unemployment and the prospect of finding a job in the future, which is in turn leading to weakening discretionary spending. Now, with all of this in mind, it's clear that many of these CEOs and executives can see the writing on the wall with the economy and are choosing to sell out partially of their stock holdings while they can still get great prices before the inevitable disconnect between the stock market and the actual real economy realigns. Now, there is a lot more concerning data out there that I have not covered in this video, and it's now looking like the wealth gap between the mega rich and everyone else is going to just get bigger and bigger. The working class and even the middle class are likely to be squeezed for all they have in the coming decade, and we could be heading towards truly scary times. Now, if you want to learn more about this, then check out my recent video, which you can find by clicking on screen right now. Aside from that, if you enjoyed this video, please be sure to leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.